We are live, Lewis. Looking live. There you go.
Yeah, just gonna crack a brew.
What kind of beverage is that, Lewis?
What'd you say?
Is that a Miller?
Yeah.
Is that a Miller? Nice.
No, it's Dr. Pepper.
Oh, a diet.
Diet Dr. Pepper. I think third one of the day.
Lovely. All right, let me get the link. Post the link. Ooh. Live stream chat. Hi. Is that you?
No. Are we on YouTube?
Ah, that's cool how Riverside and YouTube are synced, so I don't have to look at YouTube to get the comments. Sweet. Okay. Let me just post the link. And then we'll be off. 3 o'clock, 4 o'clock. Here we go.
Is LA you, or is that somebody watching the
No,
live stream?
that's got to be the YouTube. It's got to be straight from YouTube.
Hello, LA. Hello, yeah. Rob.
Yeah, Rob just posted something too. Okay, let me post this. I'm gonna post the rocket emoji. Let's hope that doesn't jinx this whole operation here.
My expectations for what the stock will do this evening are, they're not high. I will be extremely pleasantly surprised if the stock is above 25 this evening. Above 20, frankly.
Lewis, on last episode, you floated the idea that we might hit 30. Oh, Paxu saying it is out.
But is Pax?
Oh, nice.
Is Paxu giving us credible information?
Paxu, don't jump off, bud. Stay on. Oh, JK. All right. Classic Paxu. All right. So theoretically, we have 3 minutes. Lewis, any oh shoot, my Wi-Fi stinks at this house. Lewis, you're frozen. Is that me? Hold on 1 second. Where the hell are you, Lewis? My Wi-Fi is okay. Thank you, Mantan, for letting me know. That's good news. Okay, Lewis just texted me. He's alive. We'll get him back. Hold on.
I'm back.
Lewis, I was about to give you a phone call.
Dude, I don't know.
You're
My
okay.
internet's deciding to implode.
You're good?
I'm good.
A-okay? All right. Very good.
I mean, my bad. I don't.
No, you're
Are we
good.
still?
Lewis, it's 3:04. We still have 1 minute till the action. Although I
Oh,
will say,
I didn't even know. I didn't even know. if
again,
the
not to offer the jinx, but Hims is up 1% after hours on 90,000 shares traded. Imagine we'll get a million,
don't mean anything.
several million shares traded here in a moment, but we're up.
Well,
And it's 3:05. Who has the PR?
We'll see what the sequential growth is. Well, I think it comes in at 400.
Okay. Well, Hims is up 8% now. Where's the PR? Where's the PR? What was the top line? Where are we?
Expectation is 377.5 million at the midpoint, or I guess that's what the guidance was. I don't know what consensus estimates are. Do you know, Johnny?
Yeah, 382 among analysts. Although if you check the pulse of the Hims House community, 397 is the consensus. Where is it? So the stock is rallying up 7.5%, now 7.5%. Could someone post the link in the Discord?
They just haven't published it. Okay, they reported. Let's see. Oh, it's over 400. Look at
Wow.
1% tip rank channel.
Mattis 401.
Getting that correct. Wow, net income of 75.6 million, annualized nearly $300 million of net income. That's
Lewis, I'm gonna share and let's walk through it. You want to do that?
sure.
Hims is up 7%, but and I think we'll continue to update you on the stock. But let's walk through this report if that sounds good to you, Lewis.
Yeah. There's
Hold on, I'm just gonna share my entire screen. People
this
can see on
subscriber growth. Let's see what the stock's doing.
Here, let's pull this. Let's do this, and I'll keep the chat over there, and I'll pull the stock over here. Okay. Okay, so revenue 401.6, net income 75.6, adjusted EBITDA 51. Subscribers grew to 2 million.
Yeah, what's standing out to me is the sequential subscriber growth is rather tepid, but let's see what their sales and marketing expense was.
Raises full year revenue guidance to 1.46 to 1.465. Okay.
Wow, it just doesn't make sense relative to subscriber growth, how they put up such huge revenue and profitability.
You'll notice a massive look at the AOV, Lewis.
Okay, so the AOV it grew substantially as a result of the nature of weight loss drugs. Fascinating. It is a bit of a mixed report just because subscriber growth was so tepid. Let's see what the market thinks.
And given the marketing, I mean, hold on. Let's see. Okay, so we have marketing at 182 million.
Was it 182 million in the quarter? It was.
Yeah,
wow.
182 million in the quarter. What do you make of that, Lewis?
I just think each net new subscriber is very expensive. Divided by 100,000.
Here, let's add some of these numbers to our data tracker. I'll go through later and make sure this is correct, but
let's see. So
what
if
what
they
what are the key? What do we want to do
only
here?
added,
We want to do this one, right? 182.
if they only added 100,000 subscribers or a little bit over in exchange for that 182 million, the beat is just phenomenal. But yeah, I could see the market being a little displeased with growth in subscribers. But let's see the shareholder letter. Has their shareholder letter been published?
Good question. I'll pull that up momentarily. I want to get this in. Do we have an exact? Yeah, so the stock is sort of selling off here. We were up 8 or 9%, probably on the top line, whatever it was, 401 million, but stock is down. Okay, subscribers. Did we have an exact number, Lewis?
So it was over 1.9 million subscribers as of Q2 2024. Don't know what the precise number was, and then as of Q3 2024 is 2 million.
Okay. So this is, as we sort of discussed on one of the podcasts, this is a proxy for CAC, although not exact because we don't have churn. But we do know the cost of each incremental sub is 996. So it did go up, but it's not in the danger zone that was, Q2, Q3, Q4 2023. It's higher than last quarter, higher than Q1 though. That's for sure.
Well, I mean, if there's any reason the stock's selling off, it would be due to this. From a cursory glance here,
we do have the shareholder letter. You want me to scroll through that?
Sure, if it's available.
Yeah. Can you see my screen, Lewis?
Oh, yes, I can. I'll just look at your screen. I'll just read whatever data you're looking at and talk about it.
Yeah, I've been sharing the whole time. So I plugged in, marketing, trailing 12 months marketing, subscribers up to 2.0, basically 2.05 million, gives us a cost of incremental sub of 996.
Oh, yeah. Oh, well, that's reasonable. There's no issue.
Right. So that's closer to where it was here,
so
but not as bad as these numbers, right?
Yeah, no, it's totally reasonable, and it's in line with everything that we've talked about on our podcast episodes, i.e., there was much ado made about CAC going from 400 in 2022, CAC to new sub going from 400 to 1,000 as of Q2 2023. But as of today, it's still at about 1,000. And what did we just get? I think we just had the highest difference between gross profit and marketing. Don't quote me on that. We actually need to verify that that's the case.
I need to add the gross profit numbers. Actually, let's do that, Lewis, and then we'll get the chart. Let's add this in.
Yeah, there's no reason the stock.
That's a pretty big number.
There's no reason the stock should be.
That's a pretty big number. Hold on.
What's that?
Let's see. Gross profit margin. Good. Pull that over. Pull that over. No.
And then what's sales and marketing as a percentage of revenue? That's another key.
Oh, I need to drop in revenue. Hold on.
Well, I mean, the stock is incomprehensibly cheap. Incomprehensibly.
So, Lewis, the gross profit margin, 79%. Is that what we're seeing here? Yeah, 79%. So it did drop, Lewis, a bit, the gross profit margin. Although, as has been discussed on the Discord, we were expecting that given
Yeah, that's not the concern.
the situation with GLP-1s.
Yeah, the gross profit margin declining is fine, and that relates to rising expenses for vertically integrating the 503B pharmacy. They communicated that gross profit margin would decline, and over time, it's going to get to about 75% as a result of Hims investing in price, quote unquote, doing its best to lower prices for consumers and thereby increase retention and expand the overall LTV of each customer. Okay, so we have.
All right, so I'm updating the charts here.
Yeah.
A bit.
So
and I'll go through afterwards and make sure the numbers are.
Like I just said, now we know CAC per new sub didn't increase meaningfully. It's right where it's been for years. We're at the highest or near the high. We're at in the history of the company. If the company's been around for 80 months, the last 5 months out of those 80 have entailed the highest delta between gross profit margin and sales and marketing expense as a percentage of revenue, and just nominally gross profit and sales and marketing. And why is that important for the listeners? That's important because that is what allows Hims to expand its free cash flow margins. But from a really first principles perspective, that illustrates LTV to CAC. Essentially, that illustrates the value of each customer and the cash flows that each customer will produce, and ultimately what the net present value of the business is. Because any business is the present value of the cash flows that it will produce over its lifetime. And so you can distill that really to, if we pay $10 for a customer and the customer generates $100 for us over the next 5 years, then we're going to be a quite profitable business. Granted, cost of goods sold aren't outrageously high, which they could be. But so that's why it's really important for sales and marketing expense as a percentage of revenue to continue to decline or just remain static in periods where it's not, declining. So Johnny, I did the math. I think I've been very roughly doing the math, but from what I can tell, sales and marketing as a percentage of revenue did not increase in the quarter, which is very bullish if it did remain static, which is what I think it did from my cursory math here.
I don't know that I have sales and marketing.
I mean, that's arguably the only metric we should have. That's the thesis. That's everything. But
all right, well, we'll add that.
But we have CAC to per new sub, and that came in at a great level. I see this as being a great report. What were the net new ads though? What was the net new subscribers?
We had 1.8. Right.
Okay, 2047 minus 1.8.
204.
Oh, what did I say? All right. I'm totally happy with this report. Everything. There's been nothing that would cause concern in my mind. And just the one thing that I continue to reiterate is now Hims has become incomprehensibly cheap. What is the market going to do? 70.6, 75. I guess the market's just expecting GLP-1s to totally disappear. But weight loss as of today, I have miscommunicated the weight loss business in the past. in terms of its scale. As of today, it probably has done very nearly $100 million in trailing 12-month sales. As of Q2 2024, it was at annualized over 100 million. So it was probably between 26 and 30 million, I would guess, based on that characterization of in quarterly revenue. And now it's, I mean, I don't know, it's probably 50 to 100 million in Q3 2024. Of course, that was boosted by, I've been trying to pronounce semaglutide right. How do you, what's the correct pronunciation? Semaglutide?
Semaglutide.
I think it's something different than that.
Semaglutide.
All right, so annualizing HIM's net income in Q3 2024, it's now doing 302 million in net income on an annualized basis, growing at 70%, 77%. So what's a fair multiple for that? We'll say very conservatively 45 times free cash flow or net income, and we get $13.6 billion in market cap. So what the phrase is incomprehensibly cheap. Like it's just unbelievable. It's unbelievable how much the market hates this business. I'm gonna go with inconceivably cheap. That's gonna be the characterization. It's just incredible how much the market hates this business. I mean, what's going on your end, Johnny?
Well, I'm trying to read. I've never done this before. I'm a bit overwhelmed by the act of juggling messages on our YouTube, messages in the Discord, messages on Twitter, and a report that I'm trying to make sense of all at once. I think I need to just pick one and spend a little time.
Net income benefited. Okay, Lou, thank you for that clarification.
Lewis, what are you focusing on right now? Should we scroll through the shareholder letter? Should we monitor the Discord for questions? Should I look at YouTube for questions? What's your preference?
My only focus. Thank you, Lou. You're correct. Where's the DeFi?
Where are you looking? Loot 17 or
yeah,
Loot?
I'm just gonna start talking to people in the chat. DeFi, where's the increase in CAC? We did the math. Everything says that it's not. There's been no meaningful increase. Johnny, if you could take us back to the slide that shows CAC per new sub.
Yeah, once again, Lewis, I don't want to talk about it as if it's actual CAC because we don't know churn. Hold on. Here. This Lewis?
Yeah, CAC to new sub. It was just at about 1,000, which is where it's been at, and notwithstanding CAC per new sub being 1,000 for the last 2 years, now over 2 years, sales and marketing expense as a percentage of revenue has declined to its lowest point ever. I believe we'll have to do the exact math, but we're very close to or at sales and marketing being the lowest as a percentage of revenue in the history of the company, which would be contrary to this concept of rising CAC. And I don't know, I have repeated these ideas since the Spruce Short Report, in which they highlighted this concept of rising CAC per net new sub. And my contention was that it's incorrect to look at that number in a vacuum. We have to know.
There you are, Lewis. Lewis, we fell on the marketing as percent of revenue.
Okay, what's it at now?
45.39%, down from 45.91%, down from 46.93%, down from 51%, keeps falling.
Yeah, so that's DeFi to answer your question. Well, I mean, you have to look at the marketing spend as a percentage of revenue. So Johnny just shared with us that marketing as a percentage of revenue reached its lowest point in the history of the company. Yeah, the tax benefit is a real thing.
Is that right? Yeah, that is the lowest. That is the lowest print since the company went public.
Yeah. So to that end, I'm very happy with this report. There's nothing about this report that would suggest the thesis.
When did the company go? Well, let's see. I would need to get the date that the company went public. Was it public here, or did they just disclose these numbers, Lewis, upon going public?
What's that?
What's the date that HIMS? That's okay. It's the lowest. This is the lowest print in 12 quarters. 12 plus quarters.
Yes, this is essentially the lowest it's ever been. There was a period in 2020 when the COVID lockdowns boosted the performance of this metric, sales and marketing as a percentage of revenue. But this, for all intents and purposes, represents the lowest it's ever been. I mean, I think obviously.
Yeah. So Lewis, let's go over this. Let's go over this one here. 2.04, 67. Stock is beginning to appreciate that it's a solid report.
Yeah, I mean, there was nothing about this report that would indicate the thesis has weakened. I think what were the total net new subs? Was it 200,000?
180,000.
Okay.
So this exploded due to the tax benefit.
Yes, the
which
tax
the
benefit of 60 million.
Swedish diplomat on Twitter posted about a month and a half ago. Yeah, I call him the Swedish diplomat because I can't pronounce his his actual name. Aktid. This guy. Aktid diplomaten. Okay.
I think the number.
Lewis, any pages on the shareholder I should hit?
What's your question?
Any pages on the shareholder letter you'd like to see?
Well, I've been looking through it. I think the number one. I mean, the report's fantastic. Like, there's just not much to say. CAC per net new sub remained very healthy. Gross profit margin and the delta between gross profit margin and sales and marketing as a percentage of revenue remained near its widest point ever. It's a fantastic report. The company continued to generate free cash flow. It's now generated free cash flow in 8 out of its last 9 quarters, 7 out of its last 7. But what's the bear perspective to this? Why? Even I understand the I understand it's not inconceivable. It is inconceivably cheap. It was more inconceivably cheap when I forgot about the tax benefit. But even without that, let's say on the lower end of the company's guidance is a free cash flow margin of 15%. So at $401 million in Q3 2024 revenue, we have annualized sales of 1.6 billion. 15% of that is 240 million, and there's 235 shares outstanding times $22 less cash. What's the cash balance as of Q3 2024? What's it, Johnny? What's in our tracker? We only need cash. We only need free cash flow margin, CAC per net new sub, gross profit margin, sales and marketing as a percentage of revenue, cash on the balance sheet, shares outstanding. Let's see how much cash they bring in. Adjusted EBITDA continued to linearly expand, and meanwhile growth accelerated. I talked about this on my podcast recently. The combination of expanding expanding profit margin, such as free cash flow, and accelerating growth is a potent cocktail for share price appreciation. And so it makes a lot of sense that HIMSS would be up 6.5% as its bottom line margin expands in tandem with accelerating growth. This is indicative of an extremely healthy business. I have been getting at something. What's the cash on the balance sheet? Do we know? I'm gonna have to hunt this down. Let's see.
I see 165 million. No, I see.
Oh, it almost hit 250 million in the quarter. So it's cash and cash equivalents plus short-term investments. So it's roughly 200. It's roughly
okay.
250
Yeah. So if you want to add,
that's huge.
That's more than 250. Yeah.
So
at the end of the third quarter, we had over 254 million of cash. Thank you, Loot.
So if we achieve a 15% free cash flow margin, which is on the lower end of the guidance that HIMSS has produced, and about which HIMSS has been very consistent since it shared this guidance, I think years ago at this point, or maybe it was in 2023. If it hits that 15% free cash flow margin, the stock trades at 20.5 times free cash flow today if we annualize Q3 2024. So I'm being generous with I'm not really being generous. I'm not being generous. The market hates this stock. It doesn't matter. 22, it's the joke. It's like people are like $15, the net present. It's like Walmart in 1973, 1974. People are like, stock's down 75%. And they're like, the net present value of all its future cash flows, the $500 billion that it's going to generate in 2024 after we expand the money supply by 40% and thereby cause Walmart's sales to grow and to an outlier degree. It's like you look at the stock in 73, 74, and what was priced in at that point? The stock could have been 500% higher, and the net present value of it would probably have been at that point. So it's like looking at HIMSS today and people are like quibbling about $12 or $15 or $20. It's like, if the company continues this performance of expanding margins and accelerating growth, and it creates a holistic, diversified portfolio of weight loss products over the next 5 to 10 years, what's the net present value of the business? Quibbling about $12, $0.50, $15, $20. It's crazy. The net present value is probably 60 if it continues this performance. So what was my point?
Louis, I want to talk about. Yeah, go on. You're lagging tremendously, Louis, but go on.
Did you hear anything that I just said?
I heard everything, but yeah, go on. It was a little choppy. It could just be me.
No, it's definitely me. My internet died before this. I don't know what's going on with my internet. So my point is, the market continues to hate this stock. $22 is an embarrassing representation of
Pounder. Oh, God. Okay, this is not planned. Pounder, I'll be right back. Okay. Louis, can you see this?
I see a animal representation of you. Golden retriever.
We'll be right back. Okay.
I mean, I think we just had a phenomenal quarter. What could be complained about? There's nothing to complain about. I think the number one thing somebody could complain about is that they're getting a boost from GLP-1s, and they still only added, what was the net new sub ad? Was it 180,000?
Yes.
So I think the number one complaint that could be made is that despite having this booming industry, despite fielding a product in this booming industry, they're only adding 180,000 new subscribers. So, but
Lewis, I want to talk about what Marcus in the Discord just said, which is that we had 30 million in buybacks for average price of 1583, which is considerably lower than where we are now. 6 fire emojis on that comment. Any thoughts?
I mean, I'm happy with the buybacks. I think, thinking through the lens of my 4 foundational investment frameworks, my first is a vertically integrated platform. These are 4 frameworks that I use to pick stocks. The first framework is buying a business that has a vertically integrated platform. Hims is one such very good example. The second is buying a business that is poised to repurchase shares. And there's a little bit more to it. I won't get too far into it, but I think it's repurchasing shares is a very potent way to create shareholder value. And the exact mechanism there for our listeners is when you buy back shares, you're reducing the denominator in the division equation, free cash flow per share. So on top is free cash flow, that's profits. And below that is the total number of shares over which that cash flow is distributed. And so free cash flow per share is the essence of the value of the business. And so when you're buying back shares, you're reducing the total number of shares that you're distributing that cash flow over. And ultimately that increases the value of the business. Specifically, it grows free cash flow per share, because if you had $100 of free cash flow, 50 shares outstanding, you have $2 of free cash flow. If you removed 50% of those shares outstanding, you'd have $4 of free cash flow, and the business would be free cash flow per share, and the business would be worth twice as much. So for Hims to be buying back shares while also growing, accelerating growth, while also expanding profit margins, while also keeping CAC per net new sub in a healthy range, as demonstrated by the last year of expanding profit margins, while CAC per net new sub's been in this range. I mean, the report couldn't be more perfect. And this is what I'm saying. It's like, what's the value of Walmart in 73.74? I understand this is just a totally out there reference for those that listen to my podcast are very well versed in this Walmart example. But it's like, what was the, I'm guilty of quibbling about near-term share price. I am. But in the case of Hims, it's like, I just described some of the best, arguably the best execution in the growth investing universe. And so what's the net present value of the business? Is it $10, $20, or is it actually like 50 to 70? I don't know. I'm just talking. What's going on in the Discord?
Lewis, pull it up. Get a second screen.
Are they excited?
Get a 4th Dr. Pepper. Yeah, people are having a field day.
I'm trying to look at all the data.
I know it's hard.
And independently,
it's hard to do a TV show and it's hard to do a TV show and come up with analysis on the spot and monitor several separate screens and talk to you, Lewis.
Talking to me is the worst one out of them. I'm over here just rambling on about academic finance.
Should I listen to one more That's right. Should I listen to one more ramble, academic finance ramble by Lewis, or read the shareholder letter?
I'm giving you concrete, accurate accounts of what creates value in the stock market. Anyway, so what I was saying with the foundational investment frameworks, I don't want to make the conversation so academic and heavy. I really don't. But so I'm happy with him buying back shares. I think that being said, the third foundational framework is being able to become a multi-product business, innovate, expand your product set. And then the fourth is competent capital allocation, such as Zuck buying Instagram or Zuck buying WhatsApp, right? Those are demonstrations of very competent capital allocation. So what could HIMS do with this money? I personally would prefer to see them stack the cash and then make really intelligent acquisitions. I think that, just the execution is so phenomenal. And ultimately, execution for a founder CEO, what does execution mean? It means that they're very competently allocating capital. I think it's really what HIMS is doing is very unique in the sense they have mid-30s C-suite with, I think, Andrew Dudum's in his mid-30s, and I think Yemi Okupe is also either in his mid-30s or early 40s. And their competence in allocating capital is just otherworldly. It's really Zuck level. Like, Zuck is one of the best capital allocators of, I think, the last 100 years. Buying WhatsApp for 20 billion, buying Instagram for $1 billion, allocating capital to build Facebook in a really intelligent way. I think it's worth noting that HIMS is executing so well, and that is a reflection of Andrew Dudum's ability to allocate capital into labor and R&D, into sales and marketing, into actual sales reps. Do they need sales reps? Into CapEx, via which they acquire Apostrophe in the 503A facility, and Metasource RX, i.e. the 503B pharmacy. This is it's been really incredible how well they've allocated capital. And so do I like the buyback? I think the buyback's great. I'm excited about it. I think if we wanted to look at it through a very bullish lens, we would say the fact that they're allocating capital so well, they're accelerating growth, they're expanding margins, sales and marketing expenses as a percentage of revenue hit its lowest level essentially ever, removing the impacts of COVID in 2020, which made it dip really low. And they've just maxed out the opportunities in front of them. I think the last idea, I'll stop rambling here, but the last idea I'll share is that it comes back to the idea of the cadence of new product releases. They're so methodically releasing new products. They're doing it in an intelligent way. That itself is a matter of competent capital allocation. And if they're going to buy back shares, if they now see that that's the best way to create shareholder value, to grow free cash flow per share ultimately, because what is the value of a stock? It is free cash flow per share. That is the basis of the value of a stock. Free cash flow per share, the growth thereof, the durability thereof. If that's what they see in their frameworks, then it's hard to argue with anything that this management team is doing based on the numbers we see here today. All right,
Lewis, I want to do 5 or 10 more minutes, and then we'll cut to the earnings call. Regarding the earnings call, what are you listening for?
Well, I think everything's phenomenal. I guess I would say I'm listening for what Dr. H would listen for, which is what are the new product categories that are on the horizon. Coming back to what I just said, free cash flow per share is the basis of all stock value. But there's 4 points to it. And the first point is how much free cash flow per share a company generates. But we also need to consider how fast that free cash flow per share can grow or not grow, and how durable it is. For instance, for Hims, it has a finasteride product that's a for life product, and if somebody stops taking it, they start losing their hair. So that you could argue that that's a relatively durable source of cash flow. And so when management explains their product roadmap and the TAM associated with each product, ultimately that can give the market a greater confidence in how fast Hims can grow, and ultimately give the market more confidence in the value of the business as defined by those 3 points. The fourth being, what our next best alternative is, what our hurdle rate is. But if they can very compellingly and convincingly articulate, here's our weight loss product. It did $100 million in trailing 12 month sales. As of today, I think that would be accurate. And I understand that I misarticulated it in the past.
What was that? What was that number, Lewis?
I believe today.
Lewis, you lagged again. What was that number?
I believe today they're probably doing 100 million in trailing 12 months weight loss revenue.
Trailing 12 or run rate?
Trailing 12 months. As of June 30th, 2024, they probably did about 50 million roughly in trailing 12 months weight loss revenue. Today, as of November 4th, 35 days into Q4, I would argue that they're hitting that $100 million trailing 12 months weight loss level. And, but my point about it is if they can convince the market that the runway for growth is healthy, that CAC per net new sub isn't going to run to $3,000 suddenly one quarter, then, we should get a valuation re-rating. Again, I think, so what am I looking for? I'm looking for, them to continue to convince the market that the runway for growth is actually very, very long, and that 10 million subscribers is achievable. I think a good example of why this is important is Peloton, which, its growth petered out at, I don't remember exactly, but I think 5 million subscribers. And, ultimately, thinking about the 4 points, what defines the value of a business, the growth of its free cash flow is very important. And if there's no growth, then the value of that business will be much different than a business that can sustainably grow for years and years at 20 to 30%. And so Peloton's a good example, is another good reference point here, because a lot of the issues Peloton's faced were totally self-inflicted, and they were by virtue of poor capital allocation. Instead of hoarding cash, Peloton lit it on fire trying to accelerate growth. Peloton's actually a phenomenal case study in terms of what not to do. And what not to do from that case study is, don't try to grow too fast, hoard your cash, be very disciplined with capital allocation around sales and marketing, SG&A, and think a lot about new product roadmap, being methodical with that product roadmap, and just being deliberate with growth over 5, 10, 15 years. And so, Hims, on the other hand, I would say is being much more deliberate. And the product roadmap, I think, is much more obvious. With Peloton, the product roadmap was not nearly as obvious beyond, the bike. There were different products on the horizon. But I think Dr. H would be great. Dr. H. Where's Dr. H? He would be a great compliment to this conversation in terms of product.
Dr. H is around. Dr. H is not on the live stream, but he wanted us to let you know he is in the Discord. He will continue to be in the Discord throughout the earnings call, and he will certainly be on our Q3 earnings recap, which I don't know. We'll probably record that tomorrow, release Wednesday, something like that.
So, um, so I'm looking for discussions on product roadmap. I'm looking because that informs the second point of what creates value for a stock. I'm looking for a reiteration of their long-term margin guidance and a compelling articulation of how that will be achieved, because ultimately that informs this first point of equity value, stock value, how much free cash flow per share is possible on a tranche of $1 billion or on a tranche of 10 billion. We have to know what that will look like in a convincing way to understand how to value the business. And right now, again, the market. I understand that I got I forgot the tax allowance benefit for this quarter. I forgot that that was baked in. But even without that, the valuation of him suggests that the market absolutely hates this business. And so Hims just needs to convincingly tell the market, here's how much free cash flow, here are the economics on $1 billion of revenue that we generate. When you buy $1 billion of our revenue, you get a 15% yield on that billion if you're paying $1 billion for $1 billion in revenue. If you're buying $10 billion of our revenue, 1.5 billion of that is going to be free cash flow. That second time around, I said it better. The Hims needs to be able to convince the market that that will be the case. Right now, the market the market thinks that 7 out of what is it? Is it 8 out of 9 now? 7 of the last 7 quarters of free cash flow. The market thinks that's a fluke. Which again, Peloton generated free cash flow for a sustainable period of time and then literally destroyed itself through bad capital allocation and growing too quickly. So I'm not saying that the market is totally unjustified in hating this business, and it is ultimately a risky growth equity. But Hims needs to demonstrate, convince the market that on $10 billion of sales, it will generate $1.5 billion of free cash flow, or 1, or 500 million, or 2 billion, or 2.5 billion. Convince us of what that will look like. Then the team needs to convince us as to how fast this free cash flow could grow. And ultimately, that's a matter of what's your TAM? What does your multi-product platform look like in 2030 when Hims has said that they'll do at the lower end 20% adjusted EBITDA margins, which equates to about 15% free cash flow margins, So the market needs to be convinced of this runway for growth. It needs to know that Hims weight loss category could do $3 billion in sales one day across traditional oral weight loss drugs, which are not GLP-1s, across branded GLP-1s, across compounded GLP-1s, and across future drugs that arise for weight loss, right? This is one example of a product category that Hims needs to articulate so that we know what we can expect in terms of growth by year 10, right? So we need to hear our unit economics remain healthy, which we already know because we've done the math. They remain healthy. We need to hear a reiteration of guidance and how they're going to achieve that margin guidance, a reiteration of their margin guidance, which is 20 to 30% adjusted EBITDA, which equates to about 15 to 25% free cash flow margins, which is what actually matters here. And then I think just more discussion on the durability of this cash flow, which is loosely, roughly, mostly synonymous with how are they creating products that get subscribers to stick around. And that boils down to the idea that in Q2 2024, 40% of the customer base was subscribed to a personalized product, and retention is higher for personalized products. So we want to hear more about what they're doing in terms of creating product differentiation, in terms of using their AI technology to personalize products that create better outcomes for their patients. And ultimately, with that discussion in mind, we'll hear. We'll just be more convinced of how durable the cash flow is. So how much cash flow can they generate? How fast will it grow? And how durable is it going to be? Our next best alternative is the S&P 500 or whatever opportunity you have out there. So that's the entire view of what creates value for HIMS, and we're going to get a lot of discussion on these topics tonight. That's for sure.
Thanks, Lewis. All right, it's 3:55, 4:55 Eastern. I need to take 5. This hour has been fast and furious. Just to catch up the viewers that don't have their stock charts up, I'm sure all of you do, but in case you don't, Lewis, we initially spiked 8%. We fell back to earth. I think we were down 3 or 4% at one point. The stock has rallied again. We're up 7.5%, 8% after hours at $22.34 as I speak. Okay, I need to take 5, but we're going to continue monitoring the call.
Could I say
something?
Yeah. Vladimir, thank you to everybody who's messaged in the chats. And Vladimir, I think what I would say there is Palantir has become worshipped because it has had expanding free cash flow margins alongside accelerating growth. And that's exactly what we've gotten from HIMS for the last year plus. And in this quarter, we resoundingly got expanding free cash flow margins and accelerating growth. So I totally agree. The market adores Palantir, but HIMS is doing everything right and is following right in Palantir's footsteps in terms of executing, allocating capital in such a way that margins expand, growth accelerates, and that's ultimately what should drive share price over time. So there is risk, but HIMS is doing great. I'm totally happy with this report.
Hey, Lewis, there's been a request by one of our VIPs to stream Dudum from HIM's house. So I'm going to try to set that up.
Yeah, let's do it. I think it's going to be good.
I mean, the only question in my mind is, will we pick up the audio?
Yeah, we'll see.
But let's see.
Where's Paxu at? Did Paxu enjoy the report?
No, that Paxu's on the YouTube, but Paxu's certainly in the chat. Yeah, for those of you who haven't joined the Discord, hop in. Let's see. If anyone has a link to the call.
Yeah, I can share it with you.
Yeah.
Or we should share that. I'm going to share it in the Discord because
let's see.
I don't think everyone will have it. Did you share the link to this with the Discord?
There we go. Thank you, Lewis.
Look at me contributing to the Discord. Oh, really, Dog Dad? My internet imploded right before I got on here, so I'm happy to hear that.
I think it's likely that we've both had Wi-Fi issues, Lewis. I know I've had issues from here in the past. All right, I need to sign up for this account. Hold on.
I think I keep repeating it. We have about 3 minutes, Johnny. Here we have about 180 seconds before our CEO, Mr. Andrew Dudum, comes on the call. But just before we begin, I think I've already said it a few times, but the summary for this quarter is CAC per net new sub remained healthy. Growth accelerated, margins expanded, cash balance swelled, still have no debt on the balance sheet. Free cash flow in 7 out of the last 7 quarters. 8 out of the last 9. I think that's accurate now. And sales and marketing expense as a percentage of revenue hit its lowest point ever for all intents and purposes. Again, with one lower point being during the lockdown era, which created artificially low sales and marketing as a percentage of revenue. So, I mean, we can't really complain.
Can everyone hear the audio? Lewis, can you hear the audio?
I can hear the audio very well.
Can you hear the elevator music?
I can hear the elevator music.
Fantastic. Okay.
Ladies and gentlemen, thank you for standing by. My name is Krista, and I will be your conference operator today. At this time, I would like to welcome everyone to Hims and Hers third quarter 2024 earnings conference call. All lines have been placed on mute to prevent any background noise. And after the speaker's remarks, there will be a question and answer session. If you would like to ask a question during this time, simply press star followed by the number 1 on your telephone. And if you'd like to ask a question,
$10 billion
thank you.
Market cap.
I will turn the conference over to Bill Newby, Head of Investor Relations. Bill, you may begin.
Good afternoon, everyone, and welcome to the Hims and Hers Health third quarter 2024 earnings call. Today, after the market close, we released this quarter's shareholder letter, a copy of which you can find on our website at investors.hims.com. On the call with me today is Andrew Dudum, our co-founder and chief executive officer, Yemi Okupe, our chief financial officer, and Dr. Patrick Carroll, our chief medical officer. Before I hand it over to Andrew, I need to remind you of legal safe harbor and cautionary declarations. Certain statements and projections of future results made in this presentation constitute forward-looking statements that are based on, among other things, our current market, competitors, and regulatory expectations, and are subject to risks and uncertainties that could cause actual results to vary materially. We take no obligation to update publicly any forward-looking statement after this call, whether as a result of new information, future events, changes in assumptions, or otherwise. Please see our most recently filed 10-K and 10-Q reports for a discussion of risk factors as they relate to forward-looking statements. In today's presentation, we will also have certain non-GAAP financial measures. We refer you to the reconciliation tables to the most directly comparable GAAP financial measures contained in today's press release and shareholder letter. You can find this information as well as a link to today's webcast at investors.hims.com. After the call, this webcast will be archived on the website for 12 months. And with that, I will turn the call over to Andrew.
Thanks, Bill. Strong momentum from last quarter continued into the second half as we further expanded capabilities on our platform to help millions of consumers feel great through the power of better health. We made considerable progress across several dimensions that consumers value, including the speed with which they can access providers and personalized solutions to address their needs, the convenience and transparency provided by our world-class technology platform, and lastly, the breadth of personalized solutions that enables them to address concerns across our specialties in a more unique and customized way. Ongoing success in the delivery against our mission is translating into exceptional business results. Year-over-year revenue growth accelerated 25 points quarter over quarter to 77%, as we surpassed $400 million in revenue in the quarter. A disciplined approach to investment enabled us to surpass $50 million in adjusted EBITDA, reflecting a 13% adjusted EBITDA margin. Our strategy of offering high-quality, personalized solutions at mass market prices continues to resonate with consumers. We ended the third quarter with over 2 million subscribers and north of 50% of subscribers utilizing a personalized solution. We believe there are 4 primary factors driving rapid adoption of personalized solutions. The first is a continuous expansion of personalized solutions within new specialties. During the third quarter, we launched access to personalized titration schedules and dosing for semaglutide within weight loss. The second is scaling the number of compelling multi-condition solutions available on our platform that draw in a broader set of users. This includes access to personalized treatments that address multiple concerns, both within and across specialties. The third is a wider selection of form factors, unlocking access to solutions that can now be utilized via chewable or topical solution, and in the near future, gummy. And finally, as these solutions and our underlying capabilities expand, we're able to offer them at more accessible price points, strengthening a high value proposition for our customers that we believe is unmatched. Each of these developments allows us to service a broader set of consumer needs, which we believe will ultimately support more consumers sticking with their treatments and achieving positive outcomes. All of our specialties have benefited from this innovation, and we're seeing it have significant impact on the Hers brand. I've always believed that the Hers brand has the potential to eventually match, if not surpass, the size of the Hims brand, as we surpassed 400,000 Hers subscribers in the third quarter across specialties such as dermatology. It is becoming increasingly clear that this area of our business is at an inflection point. In response to this accelerating trajectory, we are excited to announce the addition of Dr. Jessica Shepard, who recently joined us as Chief Medical Officer of Hers. A board-certified OBGYN, Dr. Shepard has served patients for nearly 20 years across health issues top of mind for women, including endometriosis, sexual health, menopausal health, fibroids, and narrowing health disparities for women. More recently, she has run a clinic that has offered personalized solutions across weight management, hormonal therapy, and dermatology. Our expanding platform continues to make significant strides in unlocking access to a level of care that has historically been available to only the most privileged segments of society. As our platform continues to scale, we are seeing an increased ability to reach some of the most vulnerable populations across America. We've seen an increase in individuals from less affluent communities joining and retaining on our platform, as we've made access to personalized solutions and high-quality care available at mass market prices. We ended the third quarter with over 400,000 subscribers on the platform from zip codes where the average household income is below $50,000, with nearly 40,000 of those subscribers in weight loss. Similarly, we are seeing an increase in subscribers from older communities, where we often see mobility issues, financial constraints, and in the case of weight loss, lack of Medicare coverage present barriers to treatment. Over 100,000 of our subscribers as of quarter end are over the age of 65, with nearly 7,000 of those accessing a weight loss solution. And finally, many individuals who spend their lives caring for others and keeping our country safe and healthy often face roadblocks when seeking access to medical care. This includes teachers that educate our communities, first responders that save lives, and military personnel and veterans that keep us safe. I'm incredibly proud of our Service Appreciation Initiative, which launched on September 18th and allows us to offer U.S. military, veterans, teachers, nurses, and first responders access to personalized, compounded GLP-1 weight loss solutions for as low as $99 per month. Underpinning our ability to bring this type of value to our consumers is scale, and more importantly, scale that is supported by a continuously advancing technology platform. Our platform is enabling us to democratize a high standard of care historically accessible by only a small population. Consumers on our platform have the ability to message providers and generally address concerns within hours as opposed to days or weeks. Access follow-up care on demand, which is especially beneficial in high-touch areas like mental health and weight loss, and seamlessly access providers from the comfort of their own home, outside of traditional working hours, minimizing disruption to income from time lost commuting or sitting in a waiting room. We believe this has translated into remarkable success by drawing new customers to the platform and providing the kind of personalized support we believe is critical for patient adherence and positive outcomes. I'd like to pass it over to our Chief Medical Officer, Dr. Patrick Carroll, to briefly talk through some of the dynamics we're seeing in some of our higher touch specialties.
Thanks, Andrew. Over the course of 40 years of running my own medical practice and overseeing healthcare institutions, I have heard again and again that one of the deepest desires for medical providers was to spend more time with patients and offer them a deeper level of care. There are several hurdles that impact this ability for medical providers, which unfortunately only increased for many in recent years. These include, first, the time medical providers lose across their day as a result of navigating numerous administrative tasks with inefficient tools, and the need to operate on a non-intuitive technological platforms that are not designed for patients or providers. Hims & Hers' ability to remove these hurdles through thoughtful business practices and innovative technology centered on providing exceptional care to patients has unlocked an ability for medical providers to offer a deeper level of care to patients. This has been particularly transformational in traditionally higher touch areas such as weight loss. We believe GLP-1s have the ability to have a tremendous impact on society. However, several barriers prevent them from unlocking their full potential. Studies have shown that intolerable side effects like gastrointestinal issues and substantial muscle loss, less than desired frequency of engagement with providers, and lack of access to affordable solutions result in less than 70% of patients continuing the medication after 4 weeks of treatment. That number falls further to 42% by 12 weeks. Across the Hims & Hers platform, we have seen strong retention rates for compounded GLP-1 solutions. At 4 weeks, 85% of GLP-1 patients are engaging with the platform, including through continuation of care, completing a check-in, or proactive engagement with the provider. By 12 weeks, we observe 70% of patients continuing with their subscription. We believe there are 4 primary drivers of these great results. First, our platform enables consistent provider communication. By 4 weeks, patients have typically had at least 3 engagements with the provider on the platform. And by 12 weeks, they've had an average of 5 engagements. Once a patient reaches the end of their titration schedule, providers still engage with patients on average of at least once a month. This level of service would be incredibly challenging to offer at scale to the average consumer in the typical brick-and-mortar setting. Second, technology on our platform removes administrative overhead on providers and equips them with products and tools to better address individual patient needs. Providers on the Hims & Hers platform have access to tools with our proprietary EMR that automate notes on patients, programmatically flag certain risks, and leverage structured data to help them highlight important concerns and dynamics for providers. Additionally, capabilities such as MedMatch by Hims & Hers, our proprietary AI technology, support providers in identifying ways to balance weight loss results with the side effect management, including medication and titration schedule adjustments. Third, a wide breadth of personalized dosage options means that providers on our platform can serve a broader set of patients. Standard doses will work for many patients. However, given the diversity of obesity challenges across the American population and the concerns many have with common side effects, like nausea, vomiting, diarrhea, and muscle loss or sarcopenia, we expect there are millions of individuals who stand to benefit from personalized dosages. Finally, based on customer-reported data from more than 10,000 subscribers on a personalized weight loss program who have reached their 28-day check-in, and several thousand of those who have reached their 56-day check-in, these patients are seeing results and are indicating they are excited to continue accomplishing their goals. We have seen customers lose on average of 4.1% of their initial body weight in their first 4 weeks, while customers who have reached the 8-week mark have lost 5.5% of their initial body weight. We believe the clinical benefits of the care and personalized solutions available through our platform are clear, as we are seeing more consumers continue with their medication schedules and report positive outcomes. While both our mental health and weight loss specialties are in their early innings, I am excited by the foundation that we are laying with capabilities that we expect will expand over time.
Thanks for those insights, Dr. Carroll. As we enter the final months of 2024, I'm so excited by the momentum we are seeing and how all of the pieces we've built over the last 7 years are coming together. Our brand continues to connect with customers and is increasingly becoming known as a leader in high-quality, personalized solutions. Each of our strategic pillars, a trusted brand, leading technology platform, innovative product and services, and clinical excellence, are coalescing in a way that is enabling us to bring increased value to our subscribers at a rapid pace. We see the benefit in this with respect to how our weight loss specialty has rapidly scaled over the course of the last year. I'm impressed with how our team has come together to enable access to weight management solutions, and grateful that the company can play an integral part in taking a step toward reducing the 500,000 preventable deaths of Americans that obesity contributes to each year. While the regulatory landscape continues to evolve, the data we are seeing on our platform suggests widespread difficulty accessing name brand GLP-1 solutions. And a resolution of the GLP-1 shortage would not be possible without the potential disruption of care to hundreds of thousands of Americans. In the last 2 months, a total of over 80,000 reports have come through our platform from consumers that have been unable to obtain name brand GLP-1 treatments. And we're seeing the number of consumers voicing their frustration increase, not decrease, in recent weeks. In fact, on a single day last week, we saw nearly 2,000 indications from individuals that have been unable to obtain name brand GLP-1s. Consumers are doing their part to ensure their voices are heard, and we are actively communicating with federal and state legislative and regulatory bodies to share the experience of our customers and the dynamics that we're seeing across our platform. Our belief is that the principles that have unlocked success in other specialties provide a path for weight loss to continue to succeed when the shortage is ultimately resolved. Having a breadth of solutions that continues to expand enables us to fulfill different consumer requirements and needs while building a specialty that can be increasingly durable. We launched access to a holistic weight loss program last November for as low as $79 per month, including access to personalized oral-based solutions aimed at addressing the underlying drivers behind an individual's weight gain. Our customers using personalized oral medications as part of the holistic program have reported weight loss results that are on average at least 70% of the numbers being self-reported by customers utilizing compounded GLP-1s on the platform. The addition of GLP-1s further expanded our weight loss offering and unlocked access to these potentially life-changing solutions for a broader portion of the American population. Next, we plan to bring liraglutide, the first generic GLP-1 in the market, to the platform in 2025. We have already confirmed a core supplier for this addition, and over the next few months expect to finish completing test and batch validation, as well as confirming certificates of authenticity. Our technology platform enables us to support consumers in identifying their options and help providers match their patients with the most appropriate solution for an individual's personal clinical need. Consumers' ability to maintain frequent communication with providers as they progress through their treatment with products like GLP-1s can help them effectively balance side effect concerns with weight loss goals. We are continuing to actively invest in our 503A facilities, which we expect will enable us to continue offering personalized weight loss solutions on the platform over the long term. The ability to bring significant value to consumers by democratizing access to high-quality, personalized solutions at affordable prices has enabled us to quickly achieve scale. Continued execution on this front provides me with confidence that we can fulfill our ambitious aspiration of having every household in the U.S. using Hims and Hers for their personalized health and wellness needs. With that, I will pass it over to Yemi to walk through our financials and outlook for the remainder of the year in greater detail.
Thanks, Andrew. I will start by providing an overview of our third quarter financial performance and then discuss our updated outlook for 2024. To date, 2024 has shaped up to be a transformational year with exceptional momentum across several areas of our business. We are excited to see what was already a strong trajectory accelerate in the third quarter. It is becoming increasingly clear that there is tremendous consumer demand for the value that our platform brings, as well as for high-quality personalized solutions at accessible prices. In the third quarter, revenue increased 77% year over year to $401.6 million, with ongoing strength coming out of our online channel. Online revenue was $392.6 million, up 79% from the third quarter of last year. Expansion of our online subscriber base continues to remain the primary driver of growth across the platform. Our subscriber base grew at a record level pace with over 180,000 net subscribers added in the third quarter. We ended the quarter with over 2 million subscribers, representing a 44% increase from the third quarter of last year. While our GLP-1 offering is resulting in incremental users coming to the platform, the majority of our subscriber growth is coming from our non-GLP-1 related offerings. Our subscriber base, excluding GLP-1s, grew approximately 40% year over year. Our continued success at growing our subscriber base can largely be attributed to continued innovation across our portfolio of personalized solutions. We are pleased to achieve our goal of bringing the value of personalized solutions and care to over 1 million consumers by year end, a quarter early. We are seeing the value to customers of personalized solutions reflected on the platform in two primary ways. The first is through an ability to draw a broader audience of users who may have historically struggled to find treatments that meet their clinical needs. Personalized solutions enable us to reach a broader set of consumer phenotypes that come with different clinical requirements, concerns, and goals. For example, through innovative form factors and dosages, we are able to provide access to differentiated solutions and messaging to the individual that has suffered from hair loss for years, relative to the individual earlier on in their journey and more interested in preventative measures. North of 65% of new subscribers benefited from a personalized solution in the third quarter, and we believe this number can continue to grow with continued innovation to meet customers' clinical needs. The second way we are seeing personalization demonstrate value is through higher retention, which we believe reflects increasing consumer satisfaction. User feedback around factors that prevent them from adopting or adhering to a treatment is a core part of the design process for personalized solutions. With greater customization for individual clinical needs at affordable prices, we are seeing retention drift higher across many of our specialties. For example, in some subspecialties of women's dermatology, we are seeing annual retention increase by more than 20 points year over year, as the mix of those utilizing a personalized solution increased 40 points year over year to approximately 70% of the specialty. We believe that with continued innovation and personalization for individual clinical needs, these benefits will continue to compound across specialties in the future. Monthly online revenue per average subscriber increased 24% in the third quarter relative to last year to $67. A continued shift to more premium personalized offerings has been one contributor towards this dynamic, which has offset headwinds from a migration toward longer duration commitments that carry a lower average monthly price. The success of our weight loss specialty has been another key driver in the increase in monthly online revenue per average subscriber through two mechanisms. Firstly, our weight loss solutions carry a higher monthly average price relative to other product offerings. Historically, our offerings have ranged from $35 to $55 per month, depending on specialty and duration. Our oral weight management offering starts at $79 per month, and our GLP-1 offering generally starts at $199 per month. Secondarily, many of our existing subscribers to other specialties are adopting weight loss solutions, and subscribers that come to the platform initially for weight loss are subsequently adopting solutions across other specialties. In the third quarter, 20,000 subscribers that acquired a weight loss solution were pre-existing customers, and 20% of weight loss subscribers had a multi-specialty relationship with Hims and Hers. Increased multi-specialty adoption from our subscribers has been largely organic. In the third quarter, nearly 300,000 subscribers were treated for 2 or more conditions on the platform, inclusive of subscribers on a single treatment with multi-condition capabilities. As we continue to broaden the variety of solutions across specialties and elevate the number of multi-condition personalized treatments, we expect the number of multi-condition subscribers to continue to increase. In 2025, we expect to elevate the consumer experience for our multi-specialty subscribers through technological advancements on our platform. We believe this carries immense potential to drive higher retention as users receive multiple benefits. Effective execution of our capital allocation framework has enabled us to maintain a robust margin profile while simultaneously accelerating revenue growth. In the third quarter, adjusted EBITDA was $51.1 million, increasing 4 times relative to last year. Adjusted EBITDA margin expanded more than 7 points year over year to nearly 13%, as efficiency gains in operating expenses offset an expected degradation in gross margin associated with new product launches. Gross margin declined 2 points quarter over quarter and was 79% in the third quarter. Scaling of the weight loss specialty was the primary driver of this margin degradation. As we highlighted last quarter, lower margins are a common dynamic we often see early in an offering's life cycle. As the offering continues to scale and we are able to unlock efficiencies from automation and verticalization, we expect to offset a portion of these gross margin headwinds in the future. Management of our operating cost structure enabled us to offset pressure from gross margin headwinds. G&A cost as a percentage of revenue improved 5 points year over year and 2 points quarter over quarter to 11%. G&A expenses may fluctuate from quarter to quarter, but in the midterm, we see continued opportunity for leverage. Operations and support costs as a percentage of revenue improved 2 points year over year and 1 point quarter over quarter to 12%. We expect continued efficiency gains in these areas over the mid to long term as we benefit from scale efficiencies and further leverage technologies like clever routing to improve the performance of our customer support and care teams. Marketing as a percentage of revenue improved 6 points year over year to 45%, marking a new record in our history as a public company for the second quarter in a row. The growing emphasis on personalized solutions, along with the maturation of newer customer groups introduced to favorable pricing models, is enhancing our retention rates. Additionally, we are seeing continued success in acquiring customers through more cost-effective channels as awareness of the Hims and Hers brands grows. As we expand in categories where consumers feel more comfortable discussing their experiences, these factors are driving both growth and customer loyalty. Net income was $75.6 million in the third quarter and included a $60.8 million tax benefit related to the release of a tax valuation allowance, partially offset by current period tax expense. Recall I highlighted this possibility last quarter due to our improving certainty around long-term profitability, resulting in the increased likelihood in the utilization of our deferred tax assets. Our income before taxes was $23.6 million for the third quarter, which excludes the total income tax effects, which were impacted by the valuation allowance release. Excellent execution across the business continues to result in improving cash flow dynamics, putting us in a great position to strategically invest in growth, return capital to shareholders, and further strengthen our balance sheet. Solid free cash flow of $79.4 million in the third quarter enabled us to make strategic investments and increase cash and short-term investments on our balance sheet by nearly $27 million quarter over quarter to $254 million. In the third quarter, we saw what we believe to be a meaningful disconnect between the market value and intrinsic value of our stock. As a result, we allocated $30 million to repurchase 1.9 million shares at an average share price of $15.83 during the quarter. At the end of the quarter, there was $70 million remaining on our 100 million share repurchase authorization. Before going into our outlook for the remainder of the year, I'd like to reiterate our capital allocation priorities and give additional insight into how we intend to utilize our balance sheet. Given the momentum we are seeing across the business, we continue to believe our model is positioned to help tens of millions of individuals. As such, our first priority remains in ensuring that our platform has the necessary capabilities in place to meet the growing needs of our subscribers. While CapEx investment has been moderate through the last 2 quarters, we expect more significant investment during the fourth quarter as we further evolve our capabilities. These investments will primarily go toward 2 areas of focus. First, increasing our capacity to provide more individuals with access to a personalized solution uniquely designed to address their clinical needs. We expect these investments will position us to continue expanding the variety of form factors, multi-condition treatments, and dosage options available to our customers. Second, increasing the level of automation at each of our affiliated facilities. We expect these investments to drive greater efficiency and allow us to unlock more value for consumers, strengthening our competitive position while allowing an increasingly wider portion of the population to access the solutions available on our platform. We will continue to explore opportunities to expedite the evolution of our platform through strategic M&A transactions. While we set an extremely high bar in this regard, the MetaSource acquisition is a great example of our willingness to deploy our balance sheet towards high-value assets that we feel will accelerate our corporate strategy. With that backdrop, I'd like to provide the final update for our 2024 outlook. In the fourth quarter, we are anticipating revenue in the range of $465 to $470 million, representing a year-over-year increase of 89 to 91%. We expect adjusted EBITDA to be between $50 to $55 million, representing an adjusted EBITDA margin of 11% at the midpoint of both ranges. For the full year, we are anticipating revenue of between $1.46 to $1.465 billion, representing a year-over-year increase of 67 to 68%. Lastly, we expect 2024 adjusted EBITDA will be between $173 and $178 million. These adjusted EBITDA and revenue ranges imply an adjusted EBITDA margin of 12% at the midpoint of both ranges. Embedded in our outlook is an expectation for more substantial investment in marketing in the fourth quarter relative to prior quarters. A significant portion of this increased spend will be to build general awareness for our brand, as well as to educate Americans on the evolving dynamics and solutions in the weight management space. Current momentum of the business provides us with confidence to continue to drive 1 to 3 points of marketing leverage per annum and achieve our goal of adjusted EBITDA margins of at least 20% no later than 2030. Continued gross margin degradation is expected in the fourth quarter as our weight loss specialty continues to gain traction. Capital investment will start to reaccelerate as we invest in capabilities that we expect will enable us to fulfill an increasing portion of demand for GLP-1 solutions through our affiliated pharmacies and bring new solutions to the platform in 2025, such as liraglutide. We believe these investments will enable us to bring the benefit of our platform to tens of millions of users across weight loss and our other specialties. Our business has always centered on our subscription platform, but now more than ever, the majority of our revenue is derived from recurring subscription revenue. The focus of our strategy is centered around acquiring, retaining, and expanding our relationships with our subscribers. As a result, we will no longer report on orders and average order value after our 2024 10K filing. Our trajectory in 2024 has been nothing short of phenomenal due to excellent execution across the organization. The business trajectory, as well as the current investments in capabilities and talent, are setting a robust foundation for 2025. More and more consumers are coming to the platform as we continue to expand technological capabilities in our breadth of solutions. We are drawing world-class providers onto the platform as a result of our technology's ability to help them focus on treating patients versus handling administrative burdens. Exiting the year with over 1 million subscribers on the platform benefiting from personalized solutions and many more consumers benefiting from the potential our platform can bring is a clear signal that our strategy is resonating across America. Our ability to drive these incredible results would not be possible without the ongoing commitment and dedication from every team member at Hims & Hers. I'd like to thank them, as well as all of our customers, partners, and shareholders for supporting us in our mission of helping the world feel great through the power of better health. With that, I will now turn it over to the operator for questions.
Thank you. We will now begin the question and answer session. If you would like to ask a question, please press star 1 on your telephone keypad to raise your hand and join the queue. And if you'd like to withdraw that question, again, press star 1. We ask that you limit yourself to 1 question and 1 follow-up. Your first question comes from the line of Allen Lutz with Bank of America. Please go ahead.
Good afternoon. Thanks for taking the questions. I didn't think that I caught it on the prepared remarks, but are you providing what the GLP-1 contribution was in the quarter? Either members or revenue would be
fine. Thanks for the question, Alan. This is Yamin. We provided the year-over-year growth rate of the subscriber base excluding GLP-1s. So that number was north of 40% year-over-year.
Okay, got it. And then, Andrew, you mentioned a belief that we can continue to succeed when the shortage is ultimately resolved. you mentioned a lot of different opportunities in the shareholder letter, but can you kind of describe to us, what do you think the GLP-1 business looks like a year from now? You mentioned different form factors, you mentioned oral business growing, you mentioned liraglutide. How should we think about the way that you're thinking about the GLP-1 business maybe this time next year? Thanks.
Yeah, thanks, Alan. I think like all of our specialties, we're looking at a diverse breadth of portfolio within the product assortment. And so when you look at the weight loss business, the oral business, which we launched, the fastest business to 100 million run rate that we had on the platform, that business is delivering 70% of the weight loss of GLP-1 medicines for $70 per month. You then have medications like liraglutide, which are generic medications now coming to the platform in 2025. You have, when it comes to on-patent, off-brand medications like semaglutide, the ability to hyper-personalize for the millions of patients that need to mitigate those side effects of muscle loss and nausea and vomiting. So we think the composition of all of those different avenues will enable quite a durable business across weight. And that really, I think, is regardless of whether or not that shortage dynamic happens, in a couple of months or next year or years from now. I think the precedent specifically on the GLP-1 side for personalization and compounding to the 503A has existed for many, many years. And I think the regulators, the legislators, the drug companies, the healthcare system really respect the clinical need of that personalization when it's necessary for a patient. And given you're talking about north of 100 million people suffering from obesity in this country and the very, very high side effect rate with these medications, we fully expect that there's millions of patients that will need that level of personalization that our platform over the long haul is really well equipped to deliver on.
Great. Thanks, Andrew.
Your next question comes from the line of Maria Ripps with Canaccord. Please go ahead.
Great. Congrats on the strong quarter, and thanks for taking my questions. First, and this is the question for Patrick, actually. So you talked about sort of healthy retention rates during the initial period of treatment, especially compared to the Blue Health Intelligence study. What are some key reasons you are sort of observing that are driving some of these patients to maybe drop out during sort of the initial period of treatment, especially given that you are that you're able to personalize the titration schedule? And then secondly, more broadly, how are you thinking about the average duration of the GLP-1 patients on the platform?
Yeah, Maria, let me take the first question, pass it out on the call. When it comes to the GLP-1 study and the white paper we put out last week, the numbers were really quite astounding. As you mentioned, 70% of patients on the Hims & Hers platform that are getting this type of personalized treatment are adhering and retaining on the treatment relative to just around 40% in the traditional brick and mortar system that has been reported. That's a 30-point delta in clinical adherence. And when you look at the public data on GLP-1 adherence over the course of a year, the data is also staggeringly low. You're talking about 10 to 15% of people actually being retained. The reasons for these are relatively straightforward, but very material. You have nearly every single person who tries these medications experiencing side effects. You've got very widespread nausea, vomiting, muscle loss is a great concern, gastrointestinal issues, and for many patients, they can't bear those side effects. And so I think what's really powerful about the Hims & Hers platform is you've got the combination of factors. You've got the provider communication. As we've mentioned, providers are talking to these patients and engaging with them every single month, allowing a really robust set of communication to titrate, adjust dosing, adjust treatment regimen in order to optimize for the patient's needs and for the side effects. You've got technology underpinning this, where MedMatch is able to start helping providers set the right prescription treatment from day zero. So that could be a slower titration schedule, an end dose that is optimized for the patient's preferences. And then obviously under the hood, the capabilities on the platform allows for a really wide range of personalized dosages. This has continued to expand in Q3, and I think you'll continue to see us expand that like we have in other specialties, but more and more the nuance of understanding these patients, letting the technology and the provider and then the high touch allow for personalization is ultimately going to result in better outcomes. And for this treatment specific, given the side effect rate, I think it's going to be a key driver of much better clinical outcomes and adherence.
And then Maria, this is Yemi. To take the second part of your question, the factors that Andrew mentioned really are driving stronger retention across the platform. What we are seeing is that the brand, the transparency, and really having providers act as a partner in the care with consumers is also providing consumers with greater comfort upfront to commit to longer durations on the platform. And so I think that across the GLP-1 solutions, we are seeing consumers adopt on the higher end of the duration spectrum that currently sits at roughly like around 5 months right now for the typical consumer.
Got it. Thank you both, and good luck with the rest of the year.
Your next question comes from the line of Daniel Grosslight with Citi. Please go ahead.
Hey guys, thanks for taking the question and congrats on the strong quarter. You noted in your shareholder letter that you introduced the personalized dosing and titration for GLP-1s, and you mentioned, I think on the call, that around 10,000 folks are on that, which would make it a little less than 20% of GLP-1 members, if my math is correct. So I just wanted to confirm that I heard that correctly, around 10,000 on the more personalized titration schedule. And then on that, is it your understanding that these more personalized titrated GLP-1 dosages will be able to you'll be able to continue to compound that once the shortages abate? Is it enough to kind of get around that personalization carve out?
Thanks, Daniel. Regarding the 10,000, I think that was specific to a study that we put out on patient outcomes for GLP-1s, but I don't think it was the exact number of patients specifically on personalized doses in aggregate. I think more and more, given the nature of our business, as you know, for many years across specialties, patients are coming to us for personalization. That's the type of person that comes to us. And so I think our platform will continue to invest in catering to those needs. The compounding exemption, whether or not on shortage or not, has always allowed for the personalization when clinically necessary. And this can be in form factor, it can be in doses, it can be in combination therapies. There's very well documented and out aspects of the compound are allowed and necessary for clinical flexibility. We believe that dosing specifically for this type of a treatment to mitigate side effects is very much right down the center of what that compounding exemption is built for. I think also there's widespread awareness of this level of personalization and the benefits of it, right? When you go back to some of those white papers and the public data around side effects and clinical outcomes and adherence, like we were talking about with Maria, these people are really struggling, and we see it overwhelmingly on the platform. And most just stop, right? They stop taking the medicine for many of these reasons. And so the ability to really customize that level of care, we think, is very well respected precedent, very much within the bounds of the compounding exemption. And we also believe is very well respected across all of the parties in the industry.
Yep, makes sense. And then on the acquisition of the 503B compounding pharmacy that you recently closed, what do you need to make to get that operational and up and running on GLP-1s? And Yemi, was that a bulk of the CapEx that you were talking about increasing in the fourth quarter?
Yeah, thanks for the question, Dan. So I think that when we look at the acquisition of Metasource, I think as it stands today, it does have the capability to produce the GLP-1s. Really, the investments that we are looking to make over the course of the next couple of quarters is expanding capacity, as well as just the overall efficiency through leveraging the playbook of automation. We know that we will have scale with GLP-1s on our platform, deploying that knowledge and the playbook that we've utilized across other specialties in the past. Something that we expect to do in the coming quarters to drive more and more efficiency on that front. With respect to your second question, I think that really the CapEx will be diversified across several areas. we've received clear signal that consumers overwhelmingly are aligning with personalization, given the fact that it produces unique advantages to address their clinical needs. And so I think, as we mentioned in the prepared remarks, we now have over 1 million subscribers that are benefiting from personalized solutions, more than half of the subscriber base. So as a result, we're going to look to also, in addition to verticalizing the GLP-1 operation, start to widen the aperture, both from capacity, personalized options that we can have, but also the breadth of personalized options that we can have in the coming quarters. And so I would say that the CapEx really is a mix across those elements.
Got it. Thank you.
Your next question comes from the line of Eric Percher with Nephron Research. Please go ahead.
Thank you. Yemi, I'd like to follow on that line and just ask, I heard 503A investment for the long term, 503B in the near term. How do you think about the ability to flex on those two as the regulatory environment changes? And is there any major difference in efficiency if you need to move toward 503A?
Yeah, thanks for the question, Eric. I think that really we're going to need to be able to walk and chew gum at the same time. So we have a very talented team across the board. We also have the strength of our balance sheet with north of $250 million in the cash flow portfolio that will enable us to invest in these things concurrently. So we would expect to continue to invest in the capabilities in both the 503A as well as the 503B. With respect to the efficiency across, the two, different operations, 503Bs are generally more efficient than 503As, given the fact that we, had 503As for numerous years. We do believe that we can drive a substantial amount of efficiency. The reality is that both operations will be significantly more efficient than utilizing a third party. So we see substantial opportunity, for efficiency and greater economics within that subspecialty in the coming quarters.
And the liraglutide, is that an identification of API versus a manufacturer of a generic injectable, and does that then have to go into an NDA submission?
Hey, Eric, great question. Similar across all of the medications that we offer on the platform, there's a pretty extensive set of protocols that the supply chain goes through, and many of the times this is DMF numbers with the FDA, batch authentication, certificates of authentication that we open source to all of the patients. We do in-house and third-party independent testing of the eyes and treatments, both what is absolutely clinically necessary from a safety standpoint with the FDA, but also kind of the above and beyond that our team goes through just to get comfortable. So when it comes to liraglutide, it'll be the exact same process that we've utilized across the stack. And, we're really excited about that medication in particular, just because I think patients are really looking for value when it comes to obesity treatments. And, that medication is known, it's increasingly available. The affordability profile will be something that we think is achievable for many. And similar to our oral medications, where you're seeing, 70% of the weight loss for $70 per month, that type of value offering is really something we're pretty excited to bring to market. But same protocols and same safety standards when it comes to bringing that to customers and how we think about it.
Thank you.
Your next question comes from the line of Ryan McDonald with Needham. Please go ahead.
Hi, congrats on a great quarter, and thanks for taking my questions. Maybe to start out, it seems like the oral business and weight loss continues to perform really well despite sort of the now availability of GLP-1s on your platform. Can you just talk about how you're sort of able to sort of effectively route patients or customers to the oral option versus some of the GLP-1s, and what's really the top of the funnel driving demand? Is it customers coming in, looking for GLP-1s and sort of being made aware and educated on the oral option? Just any color there will be helpful.
Thanks, Ryan. It's a great question. In many ways, I think we see ourselves as a platform, looking a little bit like Switzerland, where we offer a wide range of treatments and services and try to help patients identify what is right for them. That could be related to clinical needs. It could be related to personal preferences, something they've heard of or something they're excited by. So there's really no, so to speak, Trojan horse where we're leveraging one medication to bring people in. The oral treatment option, as we've shared, is an incredibly robust business within the obesity business. As we shared last quarter, it's the fastest specialty we have ever launched on the platform, just the oral medication alone. And what that's doing is something really special. It's doing something that also is very rarely accessible to the mass market, which is a hyper-personalization approach to understand the underlying factors driving your weight gain. So this could be insulin resistance, metabolic disorder, binge eating, depressive dynamics and symptoms. And our SVP of weight management, Dr. Craig Primack, has been a specialist in this for 20 years. And we've brought a lot of that expertise that is available only to the 1 or 2% to the masses at scale for a price point that's very, very achievable. So I think different people have different preferences and different clinical needs. This is a treatment that is, as I was saying, delivering 70% of the weight loss of a injectable weekly gold standard GLP-1 for only $70 per month. So incredible value, which I think just naturally is attracting consumers. I think there's also a lot of comfort in the fact that these treatments in the oral business have been around for decades. The known side effects and safety profiles are very widely studied. And the fact that there's different formats, oral medication chews versus an injectable is also, I think, appealing to people. So we expect that oral business to be a large composition of the weight business, regardless of GLP-1s and liraglutide and everything to come.
Appreciate all the color there, Andrew. Maybe as a follow-up, you mentioned obviously a number of options of how the weight business is going to continue to evolve in the future. One obviously being as supply becomes available, offering the branded options. As we think about the incremental investments you're making, is there any sort of contemplation in the near term about sort of building up the infrastructure for sort of getting reimbursed and taking insurance, or would you expect even as you start to offer the branded options, continuing on the cash pay side? Thanks.
Yeah, great question, Ryan. I think right now the simplicity of the cash pay side has been relatively straightforward for patients. As most know, the actual coverage for these brand name medications when it comes to obesity is very, very low. Almost nobody without extremely high-end plans are getting coverage, and you see more and more coverage drop in quarter over quarter, even in the last couple of weeks. So the simplicity, I think, of the cash pay market is probably our approach. We will continue to try to bring more branded options to the platform because, again, choice is king, and consumers do love that choice. But with that said, I think we're excited by some of the treatments like liraglutide and the oral treatments and the personalized semaglutides and GLP-1s that offer really effective treatment at something that is more accessible to the mass market. And as we shared in the prepared remarks, we're now treating hundreds of thousands of Americans that are, in zip codes and economic brackets that really, really struggle with care. And so I think it's increasingly becoming, a really spirited, altruistic part of the business that we're really excited by.
Your next comes from the line of Aaron Kessler with Seaport Research. Please go ahead.
Great. Thanks, guys. A couple of questions. Just in terms of new sub-verticals with kind of Dr. Shepherd joining as CMO of HERS, can you just help us think through the potential kind of for new sub-verticals within the HERS category? And just within some of maybe the traditional categories you've been in, including sexual health, kind of hair, dermatology, just provide us an update on maybe performance of some of those within the quarter as well. Thank you.
Yeah, thanks, Aaron. So on the new side of the house, we're really excited by Dr. Shepherd joining. The HERS business, as we mentioned, is the fastest part of the aggregate business growing, right? It's an incredible business, and it's diversified quite dramatically across mental health, dermatology, as you shared, metabolic health, obesity. So an incredible amount of diversity taking place that's actually driving that. I think the combination of moves that we've made such as bringing Dr. Shepard onto the team, as well as the 503B MetaSource in California, which allows for sterile injectables, kind of lead towards categories that we've spoken about in the past that Dr. Shepard is an expert on. And these are categories such as perimenopause, menopause, hormonal therapy, and all of the related impacts that might have for women as they age. Same thing on the men's side of the business. We expect that business to be something that is, rolling out in the next couple of years, and something that our customers really have been wanting for some time. So that's maybe a little bit of color on kind of the new verticals to come. With regard to the core, as Yemi shared, there was 40+% year-over-year growth in our subscribers, excluding the GLP-1 business. So the core is growing very robustly. You're seeing mass market adoption of the personalization options across all of these categories, with I think it's 65-70% of new customers now opting for personalization, which is really bringing a level of clinical excellence, adherence, stickiness, retention, and customer demand to kind of all-time highs across the core, which we think has been an exciting contributor, which is even more exciting when you add in, obviously, the scale of the obesity opportunity. So it's a combination of those factors that are driving all of this growth.
Great, thank you.
Question comes from the line of Jonna Kim with TD Cowen. Please go ahead.
Thank you for taking my question. As you focus on creating more efficiency around your platform, how are you thinking about the pricing structure overall? And do you plan to lower any price in 2025? And then also, as you think about the weight loss side, will you be able to lower your pricing on that specialty as well?
Yeah, Jenna, thanks so much for the question. I think, what we constantly do as we unlock efficiency gains is we look for the best vehicles to pass that through to consumers. Some of this you're seeing in the rollout of some of the newer products, like the multi-condition treatments in sex and hair, where we're able to roll that out for as low as $49 per month for both conditions. I think that as we unlock additional efficiencies, we will definitely test, price as a lever. But, as we see the technological capabilities across the platform expand, and we also have numerous specialties, we're very excited by some of the additional creative opportunities that we can do beyond price to pass value back to consumers.
Right, and just one follow, you mentioned GLP-1 users are also using other offerings that you have. What is the strategy to further grow that sort of the cross-selling of your platform? Thank you so much.
Yeah, to date, it's largely been organic. Like what we do see is that as we have a wide breadth of specialties across the platform, users are organically opting into multiple treatments. As we look to 2025, I think that subscriber growth will largely be the continued focus in aggregate. But what we can do is, make it easier for users to opt and select into multiple bundles through removing friction points that we're aware of today. And so we would expect that number over time to go up, but largely, in the next quarter or two, will be mainly organic.
Okay. Thank you.
Your next question comes from the line of Jailendra Singh with Truist Securities. Please go ahead.
Thank you, and congrats on a strong quarter. I want to go back to GLP-1 related contribution in the quarter. It seems like GLP-1 related subscriber count was around 47 to 48,000 in the quarter. Is there any additional color you can provide us to frame the revenue contribution in the quarter? You said 12 million in 2Q. Just trying to understand the growth there. Basically, the AOV was up pretty strong sequentially, and trying to understand how much is driven by GLP-1 contribution versus like other tailwinds in the quarter.
Yeah, I think I can kind of take that in a few questions. So I think that we largely see the subscriber growth coming from the core. That said, we do see accelerating GLP-1 growth. Some of that was a result of the fact that we started to roll out GLP-1s across a broader number of states. Additionally, as consumers become more aware of the capabilities that we offer and we expand those capabilities, we do see GLP-1 adoption accelerating and increasing on the platform. I think, just kind of doing the math on the subscriber count and looking at the, rough average approximation of the monthly average revenue per subscriber can get you within the ballpark of what the GLP-1 contribution looks like.
Okay. And then going back to the comment earlier made about only 13% of GLP-1 cancel their treatment in the first month. Of the remaining 87%, are you seeing customers renewing for the same duration? Are you seeing them opting for higher duration subscription? Are you seeing like people getting comfortable signing for 3, 6, 12 months? Just trying to understand the mix of the duration in the subscription here.
Yeah, I think what we do see is, really, I think that the hurdle, like most of our other specialties, the cancellations come early on in the life cycle of a given user. As a user, particularly for medication like GLP-1s, starts to cross, the 12-week or 3-month milestone, you generally do see that the overall platform becomes sticky, and we would expect that. With respect to the duration of wait, what we mentioned in a question earlier is that we're seeing a duration, kind of in the ballpark of 5 months, and that really is just testament to consumers are enjoying the transparency that our platform is bringing. They're enjoying having providers act as partners and walk them through how to get effective care, how to manage side effects, that Andrew mentioned earlier, such as muscle loss or nausea. Providers walking consumers, through that is really resulting in strong and sound results. And as a result, we're seeing very strong performance on the typical durations that consumers are signing up for.
Great, thanks a lot.
And that's all the time we had for questions today. And ladies and gentlemen, that does conclude today's conference call. Thank you for your participation, and you may now disconnect.
So what do you think, Johnny?
Lewis. Well, apparently my Wi-Fi is so poor. People are texting me about it. Okay, well, I want to go to you, Lewis. Any quick thoughts? We're going to do a full episode on all of that and more. But why don't you take us away? Take us home.
Yeah, so, I mean, the two central thoughts, I have 3 thoughts. Let's see if I can get them all in. Number one, I would just revisit the ideas I shared before the earnings call, which were that the business is firing on all cylinders. It has expanding bottom line. It has expanding free cash flow margins. Those two ideas are roughly synonymous. It has accelerating growth. It has an expanding cash hoard. It still has no debt. It continues to launch new products, and that's a segue to my next point, which is there's such a obsession with GLP-1s, but it comes back to what I was saying before the call, which is GLP-1s are just one product, and there's going to be a combination or an amalgamation of all of these various weight loss drugs on the platform over the long run. And so the obsession and the near-term focus on this weight loss business is just, I mean, we need something to talk about at the end of the day. Analysts need something to talk about. We need to better understand the business. But in my estimation, it's mostly misguided to get so wrapped around the axle of this business. And then so the third point I would say is, so from a first principles approach, let's just value the business. Long run, it's going to do 15% free cash flow margins if you believe in the thesis. If you really believe in the thesis, then it's going to do better than that. So we did $4 billion in sales this quarter, a lot of which, or most of which, was the majority of which was the legacy business. And some people say, all right, we have to extract GLP-1s from that, and it's like, no, you don't. Growth might be lumpy, but GLP-1s are here to stay because they're weight loss, and weight loss is here to stay, and GLP-1s will be on the platform guaranteed. Like, there's no guarantees, but it's 99% chance that they're going to be on the platform long run. So there is a bit of an artificial boost, but to get so wrapped around the axle of this artificial boost that we trade the stock at, just an inaccurate net present value, I think that's the issue I take. But the third point, to really summarize this third point, 15% free cash flow margins.
Lewis, what is Lewis? My Wi-Fi is terrible. Sorry if I'm lagging. What is 99%?
It's virtually guaranteed that we're going to have GLP-1s on the platform, whether it's liraglutides, semaglutide. I'm trying to pronounce it how
Liraglutide. Yeah, it's semaglutide according to Duke.
Semaglutide.
I think I was wrong earlier. He said semaglutide.
So
liraglutide is coming. Liraglutide is coming in 2025.
Yeah.
In light of what happened these past few weeks with semaglutide, I'd say others are very much in doubt and are pending legal disputes and resolutions. Now, the personalization factor that Andrew mentioned should allow them to prescribe some GLP-1s, but I think the quantity is very much in doubt and evolving. And I do think that affects the present value.
But yeah, and I totally agree with you, and I really appreciate your perspective. What I would say though, and what I was getting at is that your perspective there, which is correct, is being taken to an extreme in the other direction. Right. And so what the third point was, let's just look at the valuation from a first principles approach. So 15% base case free cash flow margin, $400 million in sales in Q3 2024. Annualize it, we get $240 million of free cash flow, 15% times 1.6 billion. Apply a 30 times multiple to that, which would imply that the company's growing at 20-25%. And we have a valuation that's 75% higher than where it is today, roughly 50 to 75% higher. Yeah. I mean, it's like your perspective is correct. Yeah, GLP-1s are going to slow. They might come off the platform. There could be, some.
Well, they may or may not. Like, we don't know how long the shortage will last. I just want to say the situation is in doubt. That's all. We don't know.
And we don't know to what extent they'll continue to be able to sell compounded versions with unique titration and of the dose and unique scheduling and all of that. But my point is that this doubt associated with GLP-1s they're making a mountain out of a molehill. It's being expanded to the entirety of the thesis such that the stock trades as if it's growing at 10%. With highly cyclical consumer credit, subprime consumer credit cash flow durability, right? And then in the portion of this live stream prior to the call, we walked through the 4 points that comprise the basis of stock value. One, how much free cash flow per share a business generates, how fast it's growing, what's the durability, and what can we get elsewhere, which is basically how do interest rates impact the value of a business. If the 10-year treasury yield were at 10%, all stocks would be a lot lower for a number of reasons, but primarily because now you have a next best alternative, this fourth point of stock value that is much higher. If you can get a guaranteed 10% return on the 10-year that's risk-free, your calculus of what risk you want to assume will change, and that will ultimately siphon demand away from stocks. I'm going to get off this. But it's important to note. It's important to note. Because anyway. So I totally agree with what you're saying. My main point is just that we're making a mountain out of a molehill. Just because GLP-1 revenue is going to be lumpy and growth could decelerate to 25% at some point, doesn't mean we should price the whole business as if growth's already at 10%. And the cash flows are as cyclical as the most subprime credit company you could imagine. Right? That's how it's being priced right now. It's being priced like a garbage subprime lender that has 0 to 5% growth. That's what we're working with. And maybe the market's right about that. The market's been saying that for years now. The market has been contending that vehemently for years. And I get things wrong. Mr. Market gets things wrong. You could argue that Mr. Market is the embodiment of the invisible hand, which could be some kind of divinity. So maybe he's not getting things wrong and it's all kind of going to according to plan, but that's a conversation for another day. But my point is that the market has had this opinion that HIMSS is a garbage subprime lender. So its cash flows are very, very cyclical. They're not very durable. Obviously, I'm saying this facetiously. That's not actually what the market thinks. It just thinks that the cash flows are very cyclical. And I'm sorry, I just saw that comment for the first time. Hello from Florida to the person.
That was a nice comment. Here, get a load of this one though, Lewis. This was great. That was what I meant to click.
Maybe when HIMSS makes this guy money, he can afford better internet. Guy on the left, Johnny Jones. Johnny Jones calling out Johnny. Oh, I thought it was going to be one of my, I'm not even going to speak it into existence. You get stocks wrong sometimes and people make sure to remind you of it frequently. But so my main point, I wanted to summarize this for the listeners, hello to the gentleman in Denmark, is that the market has had this opinion that HIMSS is a junk, low durability cash flow business with no growth for 3 years now, at the end of which it has bigger margins than ever, sustained hyper growth, bigger cash forward than ever, no debt. 7 of the last 7 quarters were free cash flow generative. 8 out of the last 9 were. And it's a more multi-product business than it's ever been, with a successful female brand, which includes an app. I've misspoken in the past. In 2021, there was questions as to whether the female brand could be launched separately as an app and do very well. And it has. The female brand's been around since 2018. So the business is the best version of itself ever. More products than ever. And it's like, and this is at the end of 3 years of the market saying that it is this junk business. So those are some thoughts.
Thank you, Lewis. All right. You're lagging for me now tremendously. And so just to save myself and to save the viewers, and it's been 2 hours, this is going to conclude our Q3 live stream, but we'll be back very soon. You want to say one more thing, Lewis?
I just want to
I need to conclude it
as
soon as possible.
Let's see what the chat. Let's see what the Luis,
you'll be able to scroll through. You can go to YouTube. You can go to YouTube after this, and you can scroll all the way up and all the way down. All of this is preserved.
Oh, did I say 4 billion? 400 million in sales annualized. Well, I just want to respond to any questions we got. What about company's moat? Is it expanding?
Oh, okay. I was supposed to happen during the call, but that's okay.
Well, I'm sorry, Johnny.
All right, one more question. Thank you. No, it's fine. Budo's now asking a question. We are hemorrhaging listeners, though. We're at 57 now. But let's take this one more.
57.
What do you think gets analysts to re-rate the stock, Lewis?
57's a lot.
We were pushing 200 at one point.
Really? Damn, that's crazy.
No.
Let's see. Was this a good quarter?
One more question. One more question, Lewis. Let's do this final question. What do you think gets analysts? Because we have a full podcast.
Well, the whole point of doing the live stream is to interact. We're debating which.
Lewis, they were commenting the whole time. We had opportunities to engage for 2 hours. Come on.
All right, I'll just say thanks everyone for reaching out, and well, here, let me answer DK. 4 billion in sales. No, 400 million in sales. I misspoke. But don't worry, I repeat my point so many times that I get it right on the 2nd and 5th times of me circling back and repeating the same ideas. What about the company's moat? Is it expanding? So DK, I'll just answer this one really quickly. Regarding the moat question, DK Palantir, we talk about it on the main HIMS podcast, and we'll probably talk about it tomorrow. But with any younger growth business, the question of the moat is always kind of the foremost question, and we've provided answer. Let's see them gunslips. We've provided answers as to what the moat of the business is, and but I would say that my principal answer is we've shared very compelling perspectives on the moat of HIMS, and I could talk about the moat of Palantir, embedding moat, brand moat, network effect moat. But we've talked about the moat for HIMS in a very definitive way, in a very concrete way. But what I would argue is that the best version of investing is to participate in value investing. So invest in a bundle of stocks, a basket of stocks that are all quantitatively attractive. Because you and I could debate what HIMS moat is, and many people would debate what HIMS moat is ultimately, in the same way they debated the moat of Amazon, of Uber, of Tesla, all the most successful businesses, Chipotle. But at the end of the day, it is a little bit of a nebulous concept. And so the idea is to value invest. And here's where I'll summarize. I don't know that I made this point perfectly, but I'm going to summarize with this. We haven't talked a lot about the moat for HIMS today, but we have talked about the quantitative reality for the business. HIMS hasn't had a moat for the last 6 years, according to the market, in private markets and public markets. And it went public via SPAC, which could be a contention that the markets, both public and private, that transitionary phase, didn't really respect the merits of the business. So the company's not had a moat for 6 years since its founding, according to the market's hive mind, with all due respect to that hive mind. And yet today, it has its biggest margins ever. It's sustaining growth well above 50%. It has the biggest cash hoard it's ever had. It still has no debt. It's executing on its product roadmap across specialties and conditions and within both brands, HIMS and HERS. And so the business is doing the best it's ever done quantitatively, irrespective of what people feel about the moats that it may or may not possess. Quantitatively, it's the best version of itself ever. And that is the essence of value investing. We can talk about, because I've done it myself, where I've gotten investments wrong, and I've painted the most compelling economic moat scenario. The company's brand is dominant. There's real network effects, right? There's a whole website called nfx.org that's devoted to network effects. And it's a pretty complicated topic, and there's shades of network effects. And HIMS possesses some moat that entails network effects, but to what degree is debatable. And I could contend something, somebody else could contend something. So I've painted very rosy pictures for businesses that ultimately didn't work as investments. And I did so by saying they have a brand moat, they have network effect moat, they have economies of scale moat, they have an embedding or switching cost moat, maybe they have regulatory capture moat, right? But at the end of the day, all that matters is the 4 points of equity value. How much cash flow is it generating? How fast are those cash flows growing? How durable are they? And what are interest rates doing in terms of affecting our next best alternative? Or what is your next best alternative? Because maybe you can get 50% annualized, risk-free from a sweetheart deal from your uncle or whomever in your life, in which case I don't think you should be investing in HIMS. Go take that 50% annualized. But that's just an illustration of what creates value in the markets. So that's my perspective on HIMS. I've painted the perspective we have, Dr. H, Johnny, and I, of what its moats are. But at the end of the day, quantitatively, it's indisputable that the business is the best version of itself today.
One moment out there. I'm still on the call, yes.
He said, let me see them go.
All right. Oh, thank you. Yeah. I really do have to go, but we really will be back. Lewis, if you would like to continue chatting with our HIMS homies, there is the Discord. If any of you in the YouTube would like to chat with each other, there is the Discord. And Yeah, you see that?
All right,
You
all
see
right.
that
I'm
list?
just so entertained by this. I'm
And-
so entertained. Sorry, Johnny. Sorry,
And
I'm
at this
so
point,
entertained by
at this point, I am signing off. But to the 37 Hymns homies, thank you very much. This has been our first live stream. We'll see you next time. Bye-bye.
All right, I'm leaving as well. Thanks, everybody.